Investing should be simple, and conceptually it is. However, in practice, things get a bit more complicated. So let's talk about why investing should be simple, why it isn't, and how you can simplify the chaos that is the stock market. The secret to being a successful investor is that there are no secrets. You invest in the right company at the right valuation, and over time, your investments increase in value. You repeat this process over a long enough period of time, and it will generate wealth. Conceptually, this is all very easy to understand. However, in practice, investing can be very complicated. Which company is the right company? What price is the right price? And how long do I hold my position? Even if you can figure out the answers to these three questions, and in theory get it right, your investment may not materialize as expected. The stock market isn't always efficient, and investors can lose money investing in great companies. I'll touch on why that is a little bit later. Here is the most basic 3-step outline for how you should invest. Find a high-quality business. Determine if its future outlook is strong, and figure out if it's reasonably priced. If you can find a stock that meets all three of these points, all that is left to do is invest and patiently wait for a rewarding return. And you should hold this position for as long as you believe points 1 and 2 are still valid. Investing should be simple. You should be able to answer why you believe a given company meets all three of these points without performing any complex analysis. So let me unpack each step one at a time and tell you how to easily review any company with this process. The first step is finding high-quality businesses, and this is by far the easiest part of the process. While there are tens of thousands of publicly traded companies, today we have access to robust free screening tools that can help us narrow in on any subset of this universe. It is far easier to find businesses that are already great, opposed to trying to figure out which new company will go on to be great. The latter may be a more fruitful avenue to pursue, but one that is substantially more difficult. So what does a great business look like? Well, it should be growing its revenue, generating a healthy return on capital, have strong margins, and a solid track record. To find such businesses, we can apply the following screening criteria: a 5-year revenue growth rate of at least 5%, a return on capital employed of at least 20%, a gross profit margin of at least 30%, and a return since inception, also known as the compounded annual growth rate, of at least 12%. You can screen for these metrics using the free screening tool found on finchat.io. I ran this screener on July 24th, and it showed me 119 companies that met all of these conditions. I also filtered for stocks that trade on the New York Stock Exchange and the Nasdaq, since I'm a US-based investor. You can set your own exchange filters depending on where you live in the world. If you're a dividend-focused investor, you can add the following 3 metrics that will trim this universe of stocks down to just 53. A dividend yield greater than 0.01%, a 5-year dividend growth rate of at least 5%, and a payout ratio lower than 80%. 53 or 119 companies is a manageable list to work with. You can sort or further filter down this list if you'd like, to help you figure out which company you should review first. In theory, all or most of these companies should be great businesses. Of course, further due diligence is necessary to verify that these businesses are in fact growing and maintaining their metrics. This can easily be done on finchat.io by spending a few minutes looking at each company and their financials. So once you have a short list of great companies, the next step is to figure out which, if any of them, have the potential to continue growing in the future. This is a bit more challenging. I like to start my review by reading the most recent 10K for each company. No, I am not suggesting you read the entire 10K report. Spend 20 to 30 minutes skimming the report, reading certain sections, with the goal of trying to better understand how the business operates and what management is predicting for the future. Which areas of the business is management investing in? Are those segments growing? And most importantly, do you think this will be a thriving part of the economy in the future? I know these are tough questions to answer, and you may not be able to do so with a high degree of confidence from many companies. The good part is that you don't have to. If a certain company is too hard for you to understand, or you're not sure what to think about its future, simply move on. You have a short list of 119 or 53 companies to review, and you don't have to invest in all of them. It's highly likely that you'll pass up some great opportunities simply because you are unable to understand the business or its future potential. That's okay. Baseball players pass up a lot of great pitches looking for the right one, yet they still hit a few home runs. Investing is like baseball, except there is no 3 strikes and you're out rule. You get an unlimited number of pitches. You should also accept the fact that some of the companies you do select will go on to fail. It may be a great business and the future outlook may look bright, but businesses fail all the time, even ones that have a solid past. If you can win 6 out of 10 times, you're going to have one heck of a great investing career. Once you get past the hurdle of identifying a great business, and you do your due diligence to make sure it's a solid company with strong future prospects, the toughest part of all is determining the right price to pay. I'll preface this with the fact that even if you overpay for a great business that turns out to have a strong future, your returns will only marginally be impacted. Let me rephrase Buffett's famous quote. It's far better to buy a great business at a fair price than to buy a fair business at a great price. Into, it's far better to overpay for a great business than to buy a crappy one at a discount. The average investor spends way too much effort trying to precisely value a stock, when at best, you're probably going to be pretty wrong anyway. Valuation is more art than science, because the science part is way too complex for us to measure. Building complex, discounted cash flow models takes a very long time and a lot of effort, and in the end, it comes down to getting one input right, accurately predicting the rate at which a given company will grow over the next few years. Thinking that you can do this with a high level of accuracy is foolish. So given that valuations are so difficult to get right, it only makes sense to spend less time putting them together, and instead of aiming for precision, aim for reasonableness. For example, instead of putting together a discounted cash flow model, try using the reverse discounted cash flow model. It's far easier to put together and requires no assumptions. The output tells you the rate at which a given company must grow its cash flow for the current price to be reasonable. So instead of trying to figure out what the growth rate will be in the future, you are left with the question of whether the imputed growth rate is reasonably achievable by the company. Alternatively, if you prefer to value stocks using multiples, like the price to earnings multiple, compare the current ratio to the trailing average. If a stock is historically, on average, traded for a PE multiple of 20, and today its PE ratio is 40, it's pretty clear that it's expensive. If the PE ratio is 25, it may still look somewhat expensive, but not unreasonably valued. Now if the PE ratio is 10, the stock looks pretty attractive, which begs the question why? If you can't figure out why, or you disagree with the reasoning, it may be a unique opportunity to initiate a position. Keep in mind that most great companies will seldom be attractively valued, barring the entire economy being in a recession. When the stock market is in the midst of a bull run, most companies will look expensive. Inversely, when the economy is in a recession, most companies will look cheap. The problem is that if you wait to invest only during recessions, you're going to miss out on a lot of potential returns. In the end, I would say to keep valuations simple. Don't be afraid to pay a premium for a great business, and accept that you're going to be wrong pretty often. The true gauge of whether you're right or wrong will be measured years into the future. And I bet in between, some of your decisions will look absolutely horrible or terrific, only to flip in the long run. So, to quickly recap these 3 points, use a screening tool to find companies that are already great. Spend a few minutes learning about these businesses to figure out if you really like them and if you can gauge their future outlook. Use a simple method to figure out if you think the stock is reasonably priced. If you spend a half hour or so to do this for each stock before you invest, you'll be doing more research than 90% of retail investors. And you may find that in due time, you will like the returns you see from your portfolio. So tune out the noise, invest on your own terms, and evaluate your success over longer stretches of time. Have a wonderful rest of your day.